So Roth IRAs are similar to traditional IRAs in the sense that you make a specified contribution and it's limited per year, and that contribution grows tax deferred during the time that it's inside this IRA wrapper. But unlike traditional IRAs, the contribution is not deducted on the front end. So with your traditional IRA or your 401ks, you're not paying tax on the $1,000 or $5,000 that you're contributing. With the Roth IRA, you are. But in contrast, on the back end, with a traditional IRA or traditional retirement plan, you're paying income tax on 100% of whatever comes out of that retirement account when you take money out. But with the Roth, you never pay tax on any of that, not on the contribution and not on the investment growth. So while a traditional plan we would call tax deferred, Roth IRAs really do provide tax-free income. Now, there are a couple of caveats. In order to make a contribution to a Roth IRA, your income must be under a certain level. That's indexed for inflation each year, so check your textbook for the current limits. That's different than a Roth 401k. There aren't income limitations there, but for the Roth IRA, there is. However, there is a technique called a backdoor Roth IRA contribution, which is available to anyone regardless of income. The way the backdoor Roth IRA contribution works is, first of all, you can't have any balances in traditional IRA accounts. So you could have a SEP IRA, you could have a rollover IRA. Those would need to be rolled into qualified plans. And once you get rid of all your deductible, your pre-tax IRA money, so the SEP and the rollover, those need to go into, let's say, your current employer's plan. Now you have no traditional IRA balances. You start out with a new traditional IRA, you put $5,500 in it, or whatever the maximum contribution for the year is. You don't deduct it on the tax return. You wait a couple of months. If you don't invest that contribution amount and you convert it to a Roth IRA, there's no income limits to do that. So unlike putting it straight into the Roth IRA account, if you just take this extra step, you can avoid the income limitations. And if you haven't invested it, or if the account hasn't grown in value because you didn't deduct the IRA contribution, then you don't have to pick up anything up in income. Thus, you get that Roth IRA contribution. You just have to take that extra step. That's what's called a backdoor Roth IRA contribution. You'll want to make sure that you are familiar with both the backdoor Roth IRA concept and the rules surrounding Roth IRAs, because it is something that's very popular and you will have a lot of clients asking you about it. Many of them will qualify, many of them won't. So it's important that you be able to, first of all, figure out which is which, and second of all, be able to explain to your clients why they can or cannot do that. Next, let's take a look at qualified education expenses. The definition of qualified education expenses is a little bit different depending on which vehicle we're talking about, but generally, these expenses must be paid to an eligible institution. It includes tuition and fees, room and board, books, supplies, and equipment, and it must be reduced by scholarship. So this is your net out of pocket. If we're looking at the exclusion for savings bond interest used to pay for education expenses, that can only be used toward tuition and fees for a degree or certificate program. So the definition of qualified expenses for bond interest exclusion is even narrower. But the most popular type of education savings vehicle by far for the last 10 years or more is the Qualified Tuition 529 plan. I would guess that most of you are familiar with 529 plans, but let's go through the basics here. They are run by individual states, and certainly there are different costs and different investment options in that each plan runs. Some are better than others. Those change. Those are certainly something that you'll want to learn about, and certainly you'll discuss in your investment management classes, but different states have different options. There are no federal tax deductions for any of the state plans, so that is a blanket statement. Some states do offer a state tax deduction. Generally, it's pretty small. I'm not aware of any state that offers an unlimited state tax deduction. So for example, you can't make a $50,000 contribution to one child's 529 plan and get a $50,000 tax deduction, not that I'm aware of. And you need to be familiar with the states in which your clients reside, because some states don't allow any deduction at all. Some allow a deduction, but only for that state's plan. And then some states allow a deduction for any state plan. Contributions they're not a tax deduction, as we talked about, but they are considered gifts. And so you have to comply with the gift tax reporting rules, which means each spouse or each parent, mom and dad, can contribute up to the gift tax exclusion limit for the year for each child. Grandma and grandpa can do the same, but if you do more than the gift tax exclusion per child per year, then you have to file a gift tax return. There is something called the superfunding of a 529 plan that does allow you to fund up to 5 years worth of exclusions in 1 year. That will not use any of your gift tax or estate tax exemption, but it does require filing a gift tax return. So that's something that you'll cover more, hopefully, in your estate planning class, or you have if you've already taken it. But just know here that that tax return filing requirement is there even if you're not using any of your exemption. And that's important to know, because a lot of clients get excited about making these larger 529 plan contributions. You can see the money grow for a longer period of time, more tax deferral, more savings. They don't always understand that there are gift tax reporting requirements that go along with that. So if they're not doing their own gift tax returns, then there would be a cost with that. Now, if you're lucky enough to have a client who had more money in the 529 plan than any of the kids could use, they couldn't roll it to a qualified other beneficiary because there are certain classes of relatives that can receive that money. So if everybody in the family has used whatever they needed for qualified education expenses, you can take that money out. The income piece is subject to income tax and a 10% penalty. And just beginning in 2018, so with the Tax Cuts and Jobs Act of 2017, now qualified expenses for 529 plan purposes include elementary and secondary expenses. As of right now, that's only $10,000 per child. So that's not per account. You can't have a bunch of accounts and $10,000 from each account for the child. $10,000 from all accounts can be taken from a 529 plan in a given year for one child's elementary or secondary education expenses. And again, the elementary and secondary education expenses, that provision is new in 2018. So that couldn't have been done in previous years, just 2018 and later. Now, I don't know if it's the little brother or maybe the parent of the 529 plan is the Coverdell Education Savings Account. It could be the parent because it's actually older. But you can see that the ability to make contributions is extremely limited. So there really is no limit on the amount that you can contribute to a 529 plan, or I guess each plan, each state has a specified limit, but there are hundreds of thousands of dollars. Here you can see the Coverdell Education Savings Account maximum contribution is $2,000 a year. Still no tax deduction, not federal or state. And incidentally, that was the same value as the IRA contribution limit in the year that these accounts were created. That's why they used $2,000. Now, we know that IRA contributions are almost 3 times that limit now, but the Coverdell Education Savings Account limit has never changed. In addition, with a 529 plan, it does not matter what your adjusted gross income is. You can make those 529 plan contributions. With the Coverdell Savings Account, you're limited by modified adjusted gross income. Now, the reason that these accounts were still relatively popular or had some people who were interested is they always were allowed to be used for elementary and secondary education expenses as well as higher education expenses. So now that the 529 plan allows you to take some distribution as well, these will become even less popular. So we may see these fade to almost nothing, but you could have new clients come to see you with these accounts. So it's important to understand what they are and what their limits are. Next, let's talk about prizes and awards. In a future week, we will talk about how anything that an employer gives an employee is basically compensation unless you can find an exception. This is another type of rule like that. So we'll talk about employee awards in just a second, but the broader prizes and awards rule is if you win a prize on a game show, if you win a raffle, you are taxed on the market value of the car, of the house, of the vacation, of whatever it is that you win. It's not just cash, it's the value of any prizes that you win. There is an exception though. If your prize meets the 4 following conditions, then you can exclude the prize from your income. The prize needs to be connected with the fields of science, charity, or the arts. It needs to be selected based on an involuntary process, so the recipient does not apply. No further services are required of the recipient in order to receive that prize, and it needs to be assigned rather than constructively received. So basically, this is the Nobel Prize. If a Nobel Prize recipient says, "Thank you very much, I am committed to peace, I'm committed to science, I'm committed to writing, to music, whatever their passion is," they were involuntary selected. You do not apply for a Nobel Prize. It doesn't require any future services. And if the prize does not go through the recipient's bank account, that's what the constructive receipt means. If the prize goes directly to that assigned charity, or I suppose it could be another person, then the income is not included in the recipient's taxable income. Otherwise, if it's a U.S. recipient, they are paying taxes on that. Employee Achievement Awards, generally, they're going to be taxable, except if you've got that length of service or safety achievement. So a lot of companies will have a 5-year anniversary, 10-year anniversary. You can pick something out of a catalog. If that is a discriminatory plan, not qualified, only the highly paid people get it, you can exclude up to $400 worth of value from an employee's income. If anybody can get it, from the janitor to the CEO, then you can exclude up to $1,600. So that's your Employee Achievement Awards.